Yes, friends. So the first chapter will start with the financial instrument. So first of all, I should tell you. See, actually, financial instrument has got three standards. Ind AS 32, which gives the definitions. Ind AS 107, which talks about the presentation, and Ind AS 109, which is recognition and measurement. But going forward, I will talk 109. 109 includes your presentation, your definition, everything. Followed, no? Imagine now, one tiger is chasing deer. You could imagine. And if I tell that tiger has caught the deer, can you imagine a tiger catching a deer? You can see in front of your eyes. Is that this image? Is that this image? Then what it is catching? Is it catching a leg? Is it catching a tail? See, now a tiger also knows. If you have to get a control over something, what you have to catch? Catch the neck. Because the moment you catch the neck, no, you get the control over that subject or whatever it is, whatever you want to do. Now, if I have to say, this is you, okay, tiger, and the deer is like an Ind AS, and the neck of this particular subject, no, is 109. You catch it, get a hold over it. That's why I want to start this with the first, so that you understand what it is, how it operates. And the moment you get control, no, then things will fall in place, because this application you will find in consolidation also. If you have not understood this, no, then you will face a problem, because FVOCI, FVTPL, I am going to repeat it so many places. Then you will say, that's why you have to understand this very clearly, because of for its application. So what we are going to discuss this chapter, okay, I will come to the concept book. I will show you, from there we will discuss. See, in Ind AS financial instrument, we are going to discuss this chapter in 8 sections. 90% of the questions which are going to come for your examination, it's going to come within this 8 only. 10% may come from somewhere which I have not taught you. Leave it, no. At least 80% also, if you can get the confidence, you can do it very well and done. So what we are going to discuss here, initially we will discuss about the definitions, financial assets, liability, compound instrument, derivative, impairment, derecognition, hedge accounting. Hedge accounting is only a theory. We have got problems. Definition is also a theory. We have got problems only from section 2 to section 7. Okay. So again, 3 standards are there. First we will talk about the definition. Okay, there are different definitions we will discuss. What is financial instrument? What does the standard says? The standard says a financial instrument is any contract. What is the contract? Contract is what? Any written agreement between understanding between two parties, which is documented in the form of one contract. Now that gives rise to a financial asset for one entity and financial liability or equity to another entity. That means exactly there should be 2 legs to that contract. On one side, there should be financial asset, and on the other side, there should be a financial liability and equity. You should please make a note all these things. Concept book, same book I am going to give it to you later. Okay, but till that time you have to practice. Now again, this financial asset or liability can be a derivative or a non-derivative. Now, at least if you know something, you know it, you get connected. But for a fresher, so many contract is definitely they would have understood, because somewhere in the PUC Contract Act, they must have come across. Financial asset is totally a brand new word. Financial liability, since equity means you somewhere you make a guess that equity share capital. Derivative, non-derivative. That means now we have to expand on this and try to understand individual components now. And once we have understood the individual components, no, we will understand this definition very simple. Because there are examination questions, they will ask you, is this a financial instrument or not? We will discuss that also. Now, then question comes, sir, what is a financial asset? What do you mean by financial asset? What do you think? Finance. Finance means what? Money. Monetary. It is something to do with the money. My PP is not a financial asset. Fan is not a financial asset, because it is not money. It is worth money, but it is not money. Contract is a financial asset because it will talk about a fixed amount of money. Not 1 rupee more, not 1 rupee less. But when you talk about a fan or a building or fan will not be a fixed money. Tomorrow you wait one day, you may get more. Another person may offer you 10% more. Somebody may offer you 10%, 20% more. So what is a financial asset? Financial asset is any asset which is cash, hard coded, okay? Cash is always a financial asset because cash itself is money, no? Then they said, look, equity instrument in another entity, that means if you have invested in, say, Tata Motors, that becomes a financial asset. Why? On one side, it is a financial asset for you. On the other side, it is an equity for them. Are they going to give you fixed money? No. That's why these two things are an exceptions, I can say. It is a hard coding. It's not principle based definition. They said, okay, equity is an instrument, equity instrument is a financial asset. That's it. Don't ask why. This is what standard said, because financial asset should give you something expressed in fixed money. No, equity shares cannot be expressed in fixed money because today its price can be anything. But the standard said, look, no problem. Cash and equity, you treat it like a financial asset. Then they said, any contractual right to get the cash or other financial assets from another entity, for example, debtors. You sell some goods on credit. What accounting entry you pass? Sorry? Loudly. Debtors to sale. Now, where do you take these sales? P&L. Where do you present these debtors? Balance sheet, okay. In schedule 3. Assets. Under that financial assets. Why you didn't show under non-current assets? Or whatever, current, non-current, I'm not talking. Why you didn't show under PPE? Because, sir, debtor is not a PPE, no. Then what? Debtor is what? You say financial asset. I'll ask you why. Why you're telling debtor is a financial asset? Because debtor is a contract. Because you sold them under a contract, which is going to give you fixed amount of cash. It gave you a right to receive cash. Will the debtor say tomorrow I will not pay cash? What you will do? First you catch his neck. If he says I will not pay you, then you drag or you catch his collar and drag him where? To the court. The court is going to say, did you sign this contract? Is it your signature? Yes. Has he sold them? Have they fulfilled their performance obligation? Yes. Then you pay. Sir, I don't have money. No problem. I'll give you one idea what to do. Sell your private house. Pay him. I don't have a house also. Then you apply for bankruptcy there. And once you become a bankrupt, then you see what is going to, how the society is going to treat you. You struggle in your life. That's why don't get into that. Understand the implications of becoming a bankrupt. Better pay this guy. Followed, no? Now then they said, look, you have got a contractual right to exchange the financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. That means I entered into a contract. Tomorrow that contract turned to be favorable to me. Do you have an example? And you agreed to, somebody has agreed to give you cash or financial assets. Derivative. How many types of derivative contracts are there? What all those? What is a derivative contract? Betting, simple. How many types of official bettings are there in India? 4 types. Forwards, futures, options, swaps. These are all the 4 official. So whatever other things are there, you will fit in here or there only. It is a 4 major thing. So in betting contract, it is always one person gain is another person loss. Now if you entered into such type of contracts, say futures and options, and you are favorable, then that favorable is called a derivative financial asset. Follow? If you are not following, please ask me. Let us discuss right now. Now comes the another major question. And next thing, a contract that will be settled in entity's own equity instrument. That means it's my shares only, it's going to get settled. And this is the most confusing definition. The standard says, look, you have got a cash, that's a financial asset for you. You got an equity instrument invested somewhere else. That's a financial asset for you. You got a contractual right to receive the cash or other financial assets. That's under favorable circumstances. That is also a financial asset for you. Now you have got a contract where the settlement is going to happen in your equity shares. And that contract is a non-derivative contract where you have got an obligation to receive variable number of own equity shares. That means it fails fixed or fixed test. Now what is this test? We'll go further. Now for example, to give you an example, I have given a loan to someone. What accounting entry I pass? I given one loan to somebody. Loans and advances account debit to cash. Follow? Now how he should repay me? He has to repay by cash only, no? That's a normal transaction. But that guy says, look sir, I will not repay you by cash. Look, your company shares I am already holding. Like for example, I'll go to Karnataka. I'm already having 1,000 shares, Karnataka Bank shares. Karnataka Bank is listed. Karnataka Bank is listed, no? Or SBI Bank. I have got already shares of SBI Bank with me. Now I'll go to an SBI branch, take a loan. SBI branch will ask me, what security you have got? So I say, I got your own company shares. What is the price? 500 rupees. Very nice. How are you going to repay this? Sir, I will not repay you. I'll give this, your company shares back to you. Understood? You can tell no, alternately, you sell in the market and give me the cash. That doesn't matter. No? I can tell you also, no, sir, I will give your shares back. If you want cash, you sell and get the money. No. It's called a treasury shares. Where when you buy back, it's called a buyback, no? You buy back your shares, you can retain it to sell somebody else, or you can scrap it. You can finish it off. That you can remove it from your balance sheet only. And if such type of transactions are happening, where I am going to receive my own variable number of shares, then it is called a financial asset. Not understood. I'll give you example. I know that. Now they say that okay, if it is a derivative contract that is settled by the variable amount of cash for a fixed number of own equity instrument, that means you are going to receive own equity fixed number of instrument, but you are going to pay them variable share, no? That is a financial asset. Now for this, the example is a written put option. That means I have given an option to you. What is that option? At the end of the year, you can come and sell me my shares back to me. How much money I am going to pay you? I will pay you whatever price is there at the end of the year plus 20%. So that type of assets are called financial assets. We will not discuss more about this. Why? Because see, if I try to explain you, no, I have to spend 15-20 minutes to make you very clear about this with examples. There is no application of this in the entire syllabus. Probably I will give you some other material, or in YouTube I'll upload this. You can understand from this. But this particular thing we will try to understand so that you understand what is this fixed for fixed test. In simple, a derivative or a non-derivative contract that will be settled in entity's own equity which fails fixed for fixed test is called a financial asset. Because if it passes fixed for fixed test, it is called equity. Now, what is the meaning of this? You understand this example. A Limited is a company, which is you. You are given a 1 crore rupees loan to Mr. X. Or you can say SBI Bank has given 1 crore loan to X. When they are supposed to pay? After 1 year. Now we will talk about different scenario. Contract, no? What contract says? Contract says very specifically after 1 year, you have to pay me 1.1 crore. What is this 0.1 crore? Interest in cash. This is normal. This is called market. So when the transaction happens at a market, tell me what is the accounting entry I am going to pass today? Loan account debit to bank. Now, where do I show this loan? You say that it is a financial asset, show in the balance sheet. So it is not different from what you have done in PUC. Everybody will understand. Lookup will also will understand, because this is a market transaction. But if at all, SBI will give one loan to you and say that, look, today I will give you 1 crore. At the end of the year, you don't repay me. You give me your land. Looks a weird contract. Have you seen any such loan agreement? Where I will give cash to you right now. At the end of the year, what you are supposed to pay, you should need not pay me cash. Whatever that 1 acre of land you have got, no, that you give me at the end of the year. Have you come across this type of contract? It's not a collateral. The contract itself says that, see, collateral is a different concept. Collateral is only a security. Now question comes, how do you repay me? Will you repay me in cash or will you repay me in land? What does the contract says? Land. So at the end of the year, can the borrower come and say, sir, now I'm not going to give you land, I'll give you cash. Will I agree? No, I say give me that land only. Because 1 year back when I gave you a loan and when you signed the contract, that time only you should have raised the objection. No, you should have asked an option from me, either cash or land. I didn't give you any option. Today you have to sign. Oh, then you say, no, I'm not going to give you, I'll give you cash only. What I'll do? Come, we'll meet in the court. What court will say? First they'll ask, did you sign this? Yes, then give me land. Contract term says that, no. So if I pay by this, what is my accounting entry today? Understood the question? Understood the question? If I give you loan today and the contract says that after 1 year, you have to repay me not in the form of cash, but in the form of land. What accounting entry I'm going to pass today? I'll pass the same entry. But how, where I'm going to show these loans to Mr. X? In the balance sheet? Asset side only. Under assets, I just showed you schedule 3 format, no? Under schedule 3 format, where it's going to land up? Huh? Under fixed assets? So, okay, that we will discuss now. That's the crux of this definition. That's what you have to apply this definition for. Now we'll go to the third scenario. SBI has given a loan and SBI has said, look, at the end of the year, you have to give me 1.1 rupee crore worth of shares. That means today, how much is the market price of SBI shares? 500 rupees. So 1.1 crore, 1 crore, 10 lakhs divided by 500. If today you have to repay me, you should have given me 22,000 shares. After 1 year, probably the market price may become 1,100. In that case, how many shares you will give me at the end of the year? 10,000 shares. Followed, no? That means the shares are variable. It is a non-derivative contract. It is a non-derivative contract because loan is a non-derivative contract. It is not a derivative contract. Entity is obliged to receive variable number of own instrument. This is the case. Then still it is a financial asset. But the last scenario, irrespective of the market price of SBI, at the end of the year, you have to give me 10,000 shares. Irrespective, whatever. Maybe SBI share price is 1 rupee or SBI share price is 1 lakh rupees. In that case, since you have given today how much cash? Fixed cash. How much fixed shares you are going to get back? 10,000 shares. Then the last scenario, I call it equity. In all the three, this is called a financial asset. This is non-financial asset. This is financial asset. This is equity. Now, where does this implication come? For all the 4 cases, I pass the same journal entry. But on 31st March, how do I present in the balance sheet? In the first case, when I am going to get the repayment by cash under assets, non-current assets, because I am going to get this cash after 1 year, I will show under a financial assets, loan given to Mr. X. Are you very clear about the application of the definition? If at all my contract says that this will be given to me, the loan will be repaid to me in the form of a land, then under assets, you have got a non-current assets. Under non-current assets, you have got other non-current assets. There, you call it a cap. Arey Baba, form is fine. What is the substance? Is it not a capital advance? Because somebody should ask, no, arey, if your intention is to really buy the land, you show it as a capital advance, no? Why you are creating one document called a loan here? Whom you are trying to fool? This is the real face of Ind AS. Huh? which accounting standard failed actually. Accounting standard was fractured. The way you want to twist it. But India says, no, Baba, look into the substance, what they are trying to do there. Substance is it's not a loan transaction. It's actually a capital advance. Third scenario will go. What you are doing? You are buying your shares, variable number of shares. That means assets, non-current assets, but it's the financial assets only because it is following the definition. It is loan to X. But if today only, if I know how much money I have given to buy my fixed number of shares at the end of the year, it is an equity transaction. It is a transaction with the owners. It's not transaction with others. In this case, no, they have used my shares as a currency to repay my loan. But when they are paying you fixed today, on day one only I know. In this case, do I have any clarity on day one? I don't have any clarity on day one. Why? Because it can be 10,000 shares or it can be 22,000 shares. But on this, do I have a clarity on day one? What is my clarity? 1 crore rupees I have given to you, 10,000 shares you are going to give me back at the end of the year. Then do one thing, no? These loans and advances don't show on the asset side of the balance sheet. Rather than under equity, other equity, you deduct this as a buyback. But today only you know, no, Baba, it's a buyback, no. Understood the substance of the transaction. As a accountants, see now when we are going to discuss, no, you are not a finance person, you are not an auditor, you are an accountant. Think and talk like an accountant. First you think that you should be good imaginative person, because when the transaction happened, you are not there. Who entered this contract? The CEO and somebody entered and they gave the contract to you, so pass on accounting entry. Were you part of the discussion there? No. Now you have to pass an accounting entry. Now you have to think what must have happened, what they must have discussed in that meeting room, what should I account. And nobody will force you to, nobody can't force me to do accounting entry as they wish. I have to pass accounting entry as the standard says. Why? Because if I don't do it, there is one more guy comes there who is also a chartered accountant, who will come and catch my neck. Who is that? Auditor, maker and checker. That person is going to question this. They will go into the substance of the transaction. They will ask you, what nonsense thing you have done. You have not done, followed the standards. Standards told very clearly when the fixed number of shares you are going to get. For a fixed cash, what you have paid. It's an equity, right? Your presentation is wrong. You are trying to fool the people out there. Understood? Are you clear about this definition, students? And you have to remember this definition because one of the theoretical questions you have to quote this definition. Followed, no? For this you have to practice this definition. But are you clear about this definition? Yes. Any doubts? Yes. Now, can you give me some examples of the financial assets? Since you have understood the definition very well. Can you give me some examples of the what may appear under the financial assets? What do you think? Some examples we have already discussed by now. You can repeat that examples. Can you give me some examples of the financial assets? Lease is a financial asset, agreed, because it is going to give you fixed amount of cash, but it is not part of your 109 definition. It is covered by 160. It's called a net investment in the lease from the lessor's perspective. For lessee, it is a financial liability. But we are going to talk. Okay, other than that, can you give me examples of financial assets which may be sitting in the balance sheet? What is the financial asset? Okay, tell me, what is the financial asset? What is the financial asset? Cash of what? Equity shares of other companies. Then contractual right to receive cash or exchange financial assets under favorable circumstances. So you have got cash, equity shares of other companies, trade receivables, then security deposit. Okay, so we have got so many examples like cash and bank balance, investment in the equity shares, trade receivable, investment in the debentures, loans and advances given to the employees, loans and advances given to others, deposits made, security deposits. Those are all the examples of financial asset. PPE, inventory, prepaid expense, income tax refund. Why? Because you don't have any contract here. No contract in income tax refund. Income tax refund is fixed amount of cash you're going to get, but it is not a contractual, right? Gold deposited with the bank. No, cash should have been deposited with the bank, because what they are going to give you is a gold, not a cash. And gold price is not fixed there, not in fixed terms. Deferred revenue, that means some revenue you want to recognize next year. No, those are all the examples of a non-financial assets. Are you clear? Any element of doubt? Yes, Vindhya? Perfect. Now let us talk about the definition of a financial liability. Since two things were hard coded, cash and equity instrument, no, that you don't find here. Standard says, what is the financial liability? It is any liability which has got a contractual obligation to pay cash. That's what the financial instrument is all about. No, what is the financial instrument? Asset for somebody, liability or equity for somebody else. That means if the debtor has got a contract, when it comes to the debtor, you have got a contractual right to receive cash. A debtor has got exactly opposite, same mirror image of obligation to pay cash to you. Or it's exchange the financial assets under unfavorable betting in futures and options. You have got you are in a favorable situation. Now, what is that? I will discuss it little later, along with the definition of derivative. And how much profitable to you, that much is unprofitable to him, no? So, when you recognize the derivative financial assets, the other party will recognize derivative financial liability. Or a contract that will be settled in own equity instrument. When it comes to financial assets, you have received the own cash, right? Shares, right? Here, it is a non-derivative contract and you are going to deliver variable shares. Or it's a derivative contract that will be settled in the variable amount of the cash against the own equity instrument. Like in both the cases, it fails fixed for fixed test. Again, same thing I can take. Rather than I can tell you something like this. This time I have taken a loan. How should I repay? I will repay in cash. There's a financial liability. I will repay in my land. Okay. When I have taken a loan, what is my accounting entry? Bank account debit to loan. Now, how that loan taken, where should I show? Then you will tell me, sir, tell me the terms and conditions of the repayment. Okay, if I have to repay by cash, then you say it's a non-current financial liability. If I have to repay by land, then you say it's a capital advance received, which has to be, it's not a financial asset. Why? Settlement is going to happen by delivery of a land. It's a capital advance, no other non-current assets. If I had to issue by the variable number of my own shares, that means I have taken a loan today, I got a cash and I am going to issue my shares. Arey Baba, it's like an IPO, no? But the problem is how many number of shares I have to issue, I don't know. So that means till the shares are issued at the end of the year, for next 1 year, it is a financial liability to me. And the day I issue shares, what is the accounting entry I pass? Equity share, loan account debit to equity share capital account. The day I repay this by loan, equity loan account debit, because loan was already credited, because it is an obligation for me, to equity share capital. Now question comes forth. I have taken 1 crore loan today and at the end of the year I am going to issue my own 10,000 shares to you. Then what it is? Then it's the issue of shares, no Baba, because it has passed fixed for fixed test. You have received fixed 1 crore cash, you are going to issue fixed 10,000 shares, which you know right now. There is no confusion. Why you are trying to fool people that it's a loan taken and all? You tell no, you have issued shares for cash. And only thing is, cash you received in advance. Have you studied this company accounts in PUC and all? Application money, allotment money. If some of the people would have paid you in advance, what you would have done? Will you pass the entry? Bank account debit to equity share capital. What you will do? Bank account debit to calls in advance. You will land up it there. You will show it in a calls in advance, because this is like a calls in advance now. Before you issue shares, you have got the money. How can you tell it is a loan? You don't have any obligation to pay only, no? Follow? So this has failed. That's why in simple, it's a derivative or a non-derivative which is settled in own equity shares, which fails fixed for fixed test. If it passes, then it is equity instrument. Can you give me examples of financial liability? Trade payable. Now you go back to that schedule 3 and see that list of financial liabilities they have given. Trade payable, loans and advances taken for which you have to repay by cash, or variable shares. debentures or debts issued, redeemable preference shares. Irredeemable preference shares are treated as an equity. Redeemable preference shares will be treated as a financial liability. Then you will wonder, sir, in first PUC they taught me redeemable preference shares are equity share capital. That is, days are done. Today you have to redeem, that means you have got an obligation to pay cash. Non-financial liability, income tax payable because you don't have any contract. Provision for warranty, because it's only a provision. When claim comes to you, don't pay cash to them. You will repair that machine and give it back to you. And advance from the customer, how you are going to settle it? Will you refund that advance? No. If your contract says to refund the advance, then you call it a financial liability, but you are going to not refund, but you are going to give the material right. That's why it is a non-financial liability. Now, proposed dividend is a financial liability or not? Is it a financial liability, proposed dividend? No. Why? Because proposed dividend will not create any liability on you unless it is approved by the shareholders. Declared and unpaid dividend is a financial liability. The moment it is approved by the AGM, within 5 days you have to transfer to unpaid dividend account. Within 30 days you have to pay. So from that day it becomes a financial liability to you, and there is the unconditional right to avoid the delivery of the cash. That means you will pay the dividend only if you have got listed. Then I have taken a loan today. When I will repay? Only if I list my shares, then that day I will repay. Now tell me, is it what type of contract it is? What is the accounting entry I'll pass? I have taken a loan today. You say bank account debit to loan. Now where do I show this loan in the balance sheet? Liability side or equity side? Liability side. Under liability head or equity head? And then you have to tell me, sir, what is the terms of repayment? I say I will repay this only if my equity shares are listed in the stock exchange, national stock exchange. Then you say equity. Why? Because nobody can force you to list, no. And I can avoid this till I list. I will not list only. I will not repay only. Then, Papa, is it not an off-market instrument? Have you seen such type of contract where loan is taken and repayment is subject to equity listing? Will you give anybody such type of loan? Somebody comes and asks you, I'm in some financial difficulty, give me a loan. You say, give the loan. What is the terms and condition of repayment? Only if he has money, he will pay. If he wish, he will pay. Will you enter into such contract? If you have entered, that means it's called off market. And the moment off market comes, you have to understand the substance. Are you clear? Yes. Now we will go to the exceptions to the definitions. Yes. Where it will pass fixed for fixed test? See, redeemable preference shares means what? Today you have got. See, under redeemable preference shares, what happened? You have got the cash today, and you have got an equity share preference capital. Okay, are you going to pay that capital? Yes. Then, if you have got a pay to capital, can you avoid that obligation? No. That's why don't show this under equity head. When it comes to balance sheet presentation, this redeemable preference capital should be shown under liability head. I just showed you Schedule 9 format. Schedule 9 format will start with the assets, and on the liability side, it will start with the equity and liability. See, when I take this loan, equity share capital, I'll write the bank account debit to preference share capital. This is the entry. Now, when I prepare a balance sheet, okay, this is my balance sheet. I start with the equity and liability. This is my head. Second head is equity. Under equity, I have got equity share capital, part A, part B, other equity. Then starts the liability. Now tell me, preference share capital, will I show here or will I show here? This is 1, this is 2. Under heading 1 I will show, under heading 2 I will show. This is what you have been taught from the first year PUC, because preference share capital are the share capital. But Ind AS says, look, I understand the substance, no. Now redeemable means there is an obligation for you to deliver the cash. Can you avoid it? No. That means till the time it gets redeemed, no, this preference capital should be shown under the head liabilities. That means it will not come here. It will be presented here, preference share capital, which is a totally new thing, new concept. Others don't understand. But why we are showing this? Because when somebody looks preference share capital here, they understand that this is a redeemable preference shares. That means today they have got an obligation to pay some amount of cash in the future. Are you clear? Yes, clear, Darshi? No. You're not convinced. Equity share capital. Are you going to issue your equity share capital? That is fixed. Now, today you have issued shares, okay? But tomorrow you are going to issue you are not going to issue cash, redeemable, no? But instead you will, if you redeem it by cash, then I will say you are falling under this definition. First one, deliver, no, not this, here, deliver cash. Today you have got the money and you have got an obligation to pay cash. I'll say you will fall under this definition. But your obligation is not to pay cash, but your obligation is to deliver equity shares. It is redeemable. But how the redemption is going to happen? Redemption is going to happen by issue of my own equity shares. Then it will fall under this definition. Now question comes, is it a derivative or a non-derivative? It is a non-derivative. That means it will fall under this definition. Now question comes, when I redeem, am I going to issue fixed number of shares or variable number of shares? See, your question only led to this discussion. Huh? I hope students, every one of you are trying to get connected with what I am explaining here. No, you should ask me question. This point I would not have explained to you unless this question you would have asked me. Followed? So now when I am issuing preference shares, equity shares, there can be two scenarios. I will issue fixed number of shares as a redemption, or I may issue variable number of shares as a redemption. So if today I have got money, after 1 year I am going to redeem with the variable number of shares, then it will fall here and I will present it as a financial liability. If today I have got a money and after 1 year I am going to redeem it, but my redemption is going to happen based on say fixed number of shares. It is called convertible preference shares. It can be called a CCPS, compulsory convertible preference shares. You are going to come across this now. Now, how many number of shares? Fixed, no. Then today only you show it as a equity because it has passed fixed for fixed test. It is an equity. That means under here you have to show. Under this other equity you have to show this. Are you clear? And this is the question which will be asked to you. They will give you an instrument and say examine the instrument. Then you have to tell the definition, okay, what I have got today, how it's going to get settled, is there any obligation to pay cash? This is so and so, this is the compound instrument. So, this is one part of the leg, 4 marks. Second part of the leg, because they asked to examine and calculate, no, 2 verbs they use. So, first part you examine it and say, this is a compound instrument, and then you calculate and say, this is what I do. If you don't do this, see, simply you are going to lose 4 marks for nothing. If you are under having impression that accounts is only an FR is only a practical subject, 30 marks you leave. Followed, no? Because you are not written any theory there. Then your attempt itself is in 70 marks. In 70, you should find the time to complete all the calculation. If 10 marks you leave there, you are not able to attempt, or 20 marks generally first question. They will try to make you full up and down. So 20 marks you discount there first. That means literally your attempts comes in 50 marks and your calculation should be so accurate that you should be getting 50 out of 50. That's why, is there a problem if I learn theory? Learn, no. Your scope of getting marks is going to increase. But learning theory is not simple thing, students. Here learning is memorization, they will not ask you. They will give you case studies like this. And you apply there and understand what exactly is that case. Followed, no? Okay. So now we will move on to the exceptions to the definition. There are, see, again, not much discussion I don't want to hold here. There are three instruments. Entity's own instrument does not include puttable financial instrument. What is puttable instrument? Puttable means put. They are going to sell it back to me compulsorily. This is applicable for the mutual funds. They said that if you have got a puttable financial instrument, it is classified as an equity, even though by its very nature they are the financial liability. What is this meaning? Okay, there are some conditions and tests, okay, but theory questions are not asked till now. That's why I don't want to discuss much. Okay, it is here, putable instrument. We'll discuss at that time. Then they said instrument that impose the entity obligation to deliver a pro rata share of the net assets on liquidation. That means right now you know what is your obligation, but still we will classify it as an equity. This is an exception. And then they say contract for future receipt or delivery of the own instrument. Okay, this is called a written put option. So there are three exceptions to the definition of financial liability. By definition, these all the two are financial liability, but we treat them as an equity. By its very nature, this is a financial equity, but we will treat it as a financial liability. Now, what is this puttable instrument? When do you say puttable instrument? The puttable instrument is a financial instrument. That means asset for one party, equity or liability for another party. That gives the holder right to put the instrument back to the issuer for cash. What do you mean by this? Like you today go and buy one MRPL shares. Is it a puttable? Can you go and sell this share back to MRPL and say, sir, give me money? Can you tell this? What MRPL will say? MRPL will say, I will not pay you. Then what you say? Come to the court. What court will say? Question is clear. Today you have purchased the shares of MRPL company. Tomorrow you want money. You don't want that share. So you go to the MRPL and say, there whatever division is there, finance controller, sir, take these shares. Give me my money back. MRPL say, Baba, I am not going to give you. Don't talk like this. If you don't give, I know what to do. Chalo, I'll put a case against you. So when I put a case against the company, what the judge is going to tell me in the court? But what is the case for? Case is, I want my money back. Who has to pay me? Company has to pay me. What company? What the judge is going to say? Baba, come on. You should think now. You should tell me. These are all the common sense things. What the judge? Because by now you have learned all these things somewhere in the past. What the judge is going to say? What was the clause? What was the clause? When you purchased the shares from the MRPL, what was the clause? What does the MRPL say? When they will repay? Sorry? While funding, they said, I'll pay you during liquidation. Then judge will say, okay, Baba, I will order MRPL to pay you when? On the day of their liquidation. So wait up to that time. Nothing doing. Previously, court ordered, pay this. If you don't have money, sell your house and pay. This time it will not order. The order will go in favor of MRPL. Then what if I want money, what should I do? Sell it to somebody in the market. Followed? No. Now, is there any instrument where I don't want to sell in the market? I will give it back to you only and you have to pay me cash. Understood? Question is clear? Is there any instrument have you seen where I have subscribed it, but tomorrow if I want money, I will not go into the market because there are nobody to buy from that. I'll go and give it back to you. And when you give me proportionate net assets. That's the beautiful thing. Or is automatically put back to you on occurrence of certain future uncertain events. Best example is mutual funds. In mutual fund, there are two types of mutual funds. What are those? So, what is that called? What do you call for that lock in certain period and all? It's called open-ended, close-ended. In close-ended, what happens? It operates like a shares. Once you invest, unless they close and finish their project, whatever, they will not repay you. That's called a close-ended mutual fund. In that case, the only way to get the cash is to sell in the open market. The other is the open-ended, which is a majority of the cases. In open-ended, what you can do? You can give it back to the mutual fund only. Then what they will pay you? They will pay you proportionate net assets. We call it NAV. They will pay me NAV. Now tell me, students, is this instrument, a unit of a mutual fund, is it a financial asset or a financial liability? Sorry, equity or liability for the mutual fund? Liability, no, because anytime anybody can come and ask. Will you say no? No, you cannot say. Now tell me, if you treat it as a financial liability, now do they have anything called equity in their balance sheet? No. Now, is there any balance sheet where there is no equity, only financial liability sitting? No. That's why they say they have given this exception. They said that if you have got obligation to deliver the proportionate assets, even though its nature is like a financial liability, you treat it like an equity. Then what I will do? No, I will tell everything is my equity only. Then they said no. There are some test conditions for puttable instrument. One, it should entitle the holder pro rata share in the net assets. When somebody comes and asks you money back, what you are giving him? A fixed amount you are giving, or on that day, what is your net asset? It's proportionate share you are giving. You say, sir, no, I am giving NAV. Chalo, first condition is fulfilled. It is subordinate to all other classes of the instrument. Low probability in exam, okay? Till now they have never asked you this question. And just for your academic interest, I am explaining it. Otherwise, I will tell you which is important, and I hope, at this point of time you don't have, but make a mark somewhere. Now, it is subordinate to all classes of the instrument. That means it is at the bottom. Like when you talk about equity shares and preference shares, who is subordinate? Equity shares, because it is at the bottom. They don't have any priority at all. So whatever this instrument, no, it should be at the bottom. It should not have any priority to somebody. All instruments subordinate class are identical. That means in that subordinate class you have got multiple classes. Equity shares also you have got to 10 rupees paid up, 5 rupees paid up. It should have identical feature. Other than put option, there should be no other obligation, no other financial liability. That means only put option should be there. They should not say that put option with the 10% premium. No, nothing like that. Total expected cash flow should be based on the P&L and fair value change. That means what cash flow I am going to return him should have come to the mutual fund in the form of P&L revenue or the asset value changes. Nothing else. No third party sources should have come, and the issuer should know other financial contract. Like other than this, no, I should not have any other subordinate contracts. If all these conditions are fulfilled, then you call it a puttable instrument, and the moment you call it puttable instrument, even though by its very nature it is a financial liability, you will treat it as a equity. I'll give you one more example. What is this instrument impose obligation to deliver? Today I enter into a joint venture, and the joint venture term says that by 31st March I have to finish that particular project. On 31st March I have to refund your money back to you, back to the investors. My memorandum of association says no more terms there. That means I have to definitely close on 31st March. Now tell me, is it a financial liability or an equity? It's a financial liability. By definition, I know that when I am going to close, and I know how much I need to pay. But standard says, look, even though it's a financial liability, please treat it as an equity. I know that you have come only to construct one bridge. Bridge is definitely going to end, and the day it is going to end, whatever liability money you collected, you are going to repay. But treat it as an equity. And the third one, contract to delivery of the own instrument. See, I have given you an option today to repay my shares, give my shares back to me after 1 year at 50 rupees. You may give or you may not give. Followed, no? So if you give, I have got an obligation to pay cash. That's why right now you recognize a financial liability. Previous syllabus, there was one examination question. In the new syllabus, they have removed it. So I know you must have understood something, may not be fully, but fine, no need to go deeper into it. Out of your academic interest, you can do it after you finish this entire subject. Followed, no? Okay, so we'll proceed further. Yeah. Subordinate in terms of repayment or whatever claims. I told you preference, and preference is the superior one. So when you repay somebody, pay them first. This type of thing should not be there. Now, why they define, these are all called a test, okay, conditions. Why? Because people are fooling out in the name of contracts. The form, no, they fool people. That's why something should pass through different tests. And after it comes out of the test, no, then we will come to the true substance. That's why ICA is conducting so many tests of us, right? Articleship is one test. Advanced ITT is another test. CA final is another test. So many tests. And after we cross all these tests, what comes out? A chartered accountant comes out. which is the true form of someone. Like this, we have to perform tests to see what is the true form. It's called examination. Now, the last definition is the equity instrument. What is an equity instrument? Very easy. You have no obligation to pay cash. This means somebody paid you money. You don't have any obligation to repay. Can you give me an example? Equity share. When somebody gives you MRPL, you receive 10 rupees face value. Do they have obligation to repay you until you liquidate? No. Or you have exchanged the financial assets conditions unfavorable. That means even though you are unfavorable, no, you need not repay. You don't need to pay the cash. And if instrument will be settled in the own instrument, you have got no obligation to deliver a variable number of own instrument. That means what you have done? You have got an obligation to deliver fixed. That means you have received the cash and you are issuing fixed number of shares in a derivative, non-derivative contract, or will be settled in the fixed amount of share. That means whatever it passes fixed for fixed test. You have received cash, fixed amount, and going to issue fixed number of shares. That is called a equity share. So I hope by now it's okay. In case of non-derivative contract, you have got no obligation to pay cash, but settle the contract by issue of fixed shares only. Okay, anyhow, leave it. Not required at this point of time. So examples of equity will be non-puttable ordinary shares. You cannot give it back to the company. Some puttable instrument, if it passes this test, that 7 test was there, no, then only we'll call it equity. If it fails that test, if it fails this test, no, you will call it financial liability. Some instrument that impose obligation to deliver net assets on liquidation, same test is there, no. Sure shot we are going to die after that bridge is constructed. Some types of preference shares, which one? Which type of preference shares? Irredeemable preference shares only can become your equity. Redeemable preference shares is going to become equity, financial liability. And warrants, rights shares is going to be your financial equity. So financial liability and equity are the mirror image, opposite definition. So something consideration is variable, number of shares are fixed, it is a financial liability. Variable consideration, variable equity, financial liability. Variable fixed consideration, variable equity, financial liability. Only when you receive the fixed consideration, only when you issue fixed consideration, it is called an equity instrument. The only difference is, if it is a financial liability, it will be shown in item B. If it is equity, it will be shown under other equity. Presentation, only presentation is going to matter here. This definition is applicable for a presentation. So, okay. Yes. So, 2 more definitions are there. Okay, now comes to the preference share capital. Please pay your attention because examination questions will come now. Okay, they will give you different types of preference shares there. OCPS, CCPS, compound instrument. One leg is your financial liability, one leg is equity there. So many types of cases you are going to find. Now, to determine whether the preference share is a liability or an equity, you have to look into the nature, characteristics. So, in case of redeemable preference shares, redemption is going to happen at a specific date in cash. What it is? Financial liability. It's clear, no? First part you are clear, right? It's the financial liability. Now, what if the redemption is going to be happen at the option of the holder? That means if the holder wants, he will ask me in cash. Otherwise, he will continue. Or he will say, give me shares. It is redeemable. That means he will, if he want, he will ask me cash. No, I may have to pay or whatever it is. In that case also is a financial liability, because can you avoid paying cash? No. But if the redeemable preference shares you have issued and the redemption is at my option, then on day 1 only I will treat it as an equity, because I will never exercise that option. Like you have taken a loan from the bank. Terms of condition is whenever the borrower wants. Borrower will never want. So it sounds like bank has invested in the capital, no baba. It's a base capital, right? Like parents are going to invest in the kids' base capital. That's like that, no. So why you are not treating it as a liability? It's like parents giving money to us. It's an equity capital, it is an investment. Now, what if it is a non-redeemable? See, when it comes to non-redeemable, that means principal, you classify it as equity only. But question comes, what about the dividend? Dividend can be cumulative or non-cumulative. If it is non-redeemable, non-cumulative, then both the elements are equity only, because I need not pay you. But if the dividend is the cumulative, mandatory dividend, then the principal is the equity, interest is the liability. And this type of instrument we call compound financial instrument, because there are two legs there. Then we have to do one accounting called split accounting. We have to take one portion separate, another portion separate, and we have to account both the differently. For this, we have to be very clear about the definition. Followed, no? You are very clear now, till now? Okay. Now we will talk about the derivative contract. What is a derivative contract? So accounts give the definition that derivative contract is any contract where the value is going to change based on the underlying, that means index, rate, commodity price, etc. It has got no or little investments right now, or it will be settled in the future through delivery or net settlement. There are four types of derivative: forwards, future, options, swaps. So if you want to tell any instrument as a derivative instrument, all the three conditions has to be fulfilled. If any one of the condition is not fulfilled, then you call it non-derivative contract. Now, for example, I'll give you one simple example of a forward. Tomorrow morning, 3 o'clock, you are landing in the railway station. So, if there is no rickshaw, you are into a problem. So, what you will do? And one more problem comes. If there is a rickshaw, then also you have got one problem. What is that? What they are going to quote in midnight, 3 o'clock? Whatever they have to quote, you have to tell. Now, what you will do now to avoid this uncertainty? You will today only, you go to one rickshaw driver and say that, look, next day morning, 3 o'clock, I am going to come. Will you come to pick me up? He says, why not, sir? Definitely. Then what you will do? You say, what is my price? You have to fix the price now. Because if we say, sir, whatever available in the market, you pay me, then say, what is the difference between you and those people there? And that price is changing. That price is changing based on what? Based on the demand and supply. If in the train, lot of passengers will come, the prices are going to skyrocket. Per trip, 500 rupees they will charge. That day, in that passenger, only 5 passengers came, your supply is more, then they will charge per trip 100 rupees. Now, when you talk to this rickshaw driver, sir, you come there. Now, problem comes, what is the price? Because if we say, sir, I will charge you that day's price only, then same variability, no. Why you have to enter into a contract? Then you finally negotiate and says, I will pay you 250 rupees per trip. Now, does this contract a derivative contract? Is it a derivative? Which type of derivative it is? It's a forward. Like we see that in our day-to-day life, so many forwards we are entering. My birthday party is there. I went to one, who is that called, caterer, and told him, on 30th April, you give me 100 people's food at so and so price. Chalo, forward contract. So every single purchase order is a forward contract. Followed, no? Now, does it fulfill these three definitions? Yes, first thing, the value changes based on the underlying. Now, 250 rupees you fixed. On the day when you arrived, on say 31st December, there can be two scenarios. One, that day market prices are 500 rupees, or that day market prices are 100 rupees. Is this contract values are going to change accordingly? Yes. If it is 500, who is happy? You are happy because you saved 250. Exactly, that rickshaw guy becomes sad. This is a zero-sum game, no. It's a betting actually. If it is 100, you are sad, and exactly 400 rupees he is happy. Because you think, why I entered unnecessarily, I should not have entered only. But did any of the parties know on 31st December how many passengers are going to get down from the train, how many rickshaws will be available? Nobody knows. There is an uncertainty. Followed, no? So this is called a forward. Now, did you make any investment right now? No. So this condition fulfilled. And when it is settled, on the day rickshaw comes, you come and you pay the money. Since all the three conditions are fulfilled, you say this contract to hire a rickshaw in the future at 250 rupees is a forward contract. Now what is future? Same forward only, you enter into a stock exchange. What is option? Same forward, but you get one option. You tell him, look sir, you come at 3 o'clock, I will take or I will not take. Then when you will exercise this option, if the market price is 500 rupees, you will take this rickshaw at 250. He will cry. If market price is 100, this rickshaw guy comes morning 3 o'clock. You say, I don't want your rickshaw because you will take somebody's rickshaw for 100. Now, is that rickshaw guy fool there to give you this option? He will ask a premium. Yes, clear no students? Futures, forwards. I am giving simple example. We can talk complicated example also. What is a swap? You hired a rickshaw at 250. Now, that day, actually you have to go for say some this thing, bride to see the bride and all. And there is one guy, your friend. He has hired one car at say 250 rupees. But his problem is, both are coming in by the same train, 3 o'clock train. Now, his problem is, the car will not go to his particular house. Why? Because it is a very narrow. He wanted rickshaw. Rickshaw is not available. You wanted actually car because you are going to some business meeting or something. You can't go in the rickshaw, no? So you wanted a car, but car was not available. So you booked a rickshaw. What you will do? Simple, you swap it. You tell your friend, you take, see, in this swap also somebody will gain, somebody will lose. But this is a swap contract. Okay. Now, the next part is the contract to buy or sell non-financial items. So I hope you are clear about the derivative contract. Derivative means three conditions should fulfill. You have to look at the question and say whether it is a derivative or not. Now, contract to buy or sell non-financial items, it's called own use exemption. It says that Ind AS 109 is not applicable to own use contract. That is, if you have entered into any derivative contract, say forward contract, for your own consumption, then don't pass any accounting entries calling it a derivative contract. It's called executory contracts. You can treat as such normal purchase only and don't apply derivative account. This is called own use exemption. Okay, we'll discuss this later. Now, when it is not available, the non-financial items will be net settled in cash. It's not available. And a contract to buy irrevocably designated FVTPL item, I will discuss this again, okay? Because explaining more about this FVTPL designation and all makes more sense. I will discuss during hedge accounting. And a return option is also a return option to buy sell is also when these conditions fulfill, you don't get this exemption. We'll discuss it later, not right now. Okay, the last definition is the fair value. What is a fair value? Because we are going to talk about fair value. What is fair value? What is fair? What is fair? In audit we use this, no? What is fair? Acceptable. Now, a price, because we are going to talk that financial instruments should be measured at a fair value. What is a fair value? It is a price that would be received to sell an asset or paid to transfer the liability in an orderly transaction between market participants on the measurement date. Now, to measure, no, we have to use the same assumptions the market participants will use. Okay, we'll have one game, okay, so that you understand and appreciate what is fair value. In this game, this is me and this is you. You understand what is fair value? Okay, game goes like this. Somebody will give you 100 rupees note and says that, look, in this 100 rupees, you have to make two portions. One portion you keep it with yourself. Another portion you give to Nagbhushan. So you decide how much you want to keep, you keep it yourself. Another you give to Nagbhushan. One number came in your mind automatically. Then he says, there is one more rule to it. I have already told this story to Nagbhushan that some portion you are going to retain. If he is going to reject whatever is being offered to him, then both of you will not get this 100 rupees. So you have to decide one number which is acceptable to me. If I find it is not proper, I say I don't want, then both of us will not get. Now, one more number came in your mind automatically. And if I have to guess, when I ask the first thing, is it 99:1? And second time, is it 50:50? Or whatever. Definitely when the first time, no, it is not 50:50. You got one number in your mind, no, which is other than 50:50. But when I said Nagbhushan is going to reject it, did automatically 50:50 came in your mind? This is called fair. See, understand, in a fair value, the market participants understand, they are intelligent people. You can't simply fool someone. They are knowledgeable, they are independent. When I played this game with my brother, no, on first occasion only he said 50:50. I was surprised. How did he tell me? How did that number came to his mind? Then I understood there is one more standard called Ind AS 24. What is that? Related parties. Between related party it may not work. Followed, no? But with the unrelated party it will work. Because everybody, see, they go with the understanding that every market participant will think from their best interest. When I am sitting here, I think from my interest. You are sitting there, you think from your interest. That is that underlying economics. You can call it, word is very selfish and all. Okay, Baba, it should be now. We have to think about ourselves, right? Then we will think about others. So this is, there should be reasonable and sufficient information. Okay, clear? So this is called a fair value. We will figure out how to arrive at that fair value, how to work out.